So I was saying, yeah, so every year the landlord can only increase the rent for, well, I don't have the exact number, but maybe 1 to 2%. So what they are currently paying may be much lower than the potential market rent. So if your client asks you, how much down payment do I need? You should always first ask the seller for the current monthly rent and expense information, and have us work on the numbers to give you an estimated loan amount, so you know how much the client will have to put aside as a down payment. So that's for multi-residential. Industrial is, so these buildings can have one or multiple tenants, and similar to multi-residential, the maximum loan amount is 75% if the property is located in the GTA. So very often, the owner can occupy some of the space for their own operating company. If the owner occupies less than 50% of the total space, we will treat the property as an investment building, which will be financed by way of a commercial mortgage. On the other hand, if the owner occupies more than 50% of the leasable space, then we would treat the building as a owner-occupied property. In that case, we would need to assess the financial statements for the operating company to determine a maximum loan amount. And very similar to multi-residential properties, there's been very minimal impact to the property's income in the industrial space. We've seen that vacancy rates have decreased since the pandemic hit last year. So very high demand for industrial buildings, especially anything food related, food manufacturing, distribution, e-commerce, warehousing, distribution and logistics. So these assets continue to be very strong in the market, and we continue to entertain transactions to finance industrial properties as well as multi-residential properties. So the assets we'll touch on next are those that have been impacted by COVID. So first of all, office. Office is an asset where we are proceeding with caution for obvious reasons. Lots of small businesses were forced to shut down during COVID. So office vacancy continues to increase, and it's very high. So we'll be very careful with this type of property. We still entertain transactions in this space, but we look for established tenants, regional, national brands, multinational brands that we know can ride through the pandemic. We look for large organizations, for example, large law firms, medical offices, and government agencies who have no issues paying rent. Then absolutely we'll be able to entertain these transactions. However, if the tenants are small businesses that are struggling a little bit or have rents in arrears, then we may want to hold or defer the transaction until the tenants are back on track, so that the rental income would allow for a mortgage amount that's closer to the requested amount. So, but same as industrial, if the owner occupies less than 50% of the space, then we treat the building as an investment property. If the owner occupies more than 50% of the leasable space, then we would be looking at the financial capability of the operating company for the owner. So moving on to retail. Retail is very similar to office space. Vacancy is going up for the same obvious reasons. So at this time, we're being very careful, but we still have a great amount of appetite to entertain the transactions that have tenants, that are again large and established, especially the retail properties that are grocery anchored, pharmacy anchored, for example, Shoppers and Rexall, banks anchored that have not had any issues making monthly rents since and during the COVID period. So then absolutely we'll be able to entertain those transactions. Next is mixed use. Mixed use is primarily seen in downtown Toronto, where you have one or multiple commercial units on the ground floor and some apartments on the upper floor. So for these types of transactions, it's going to be dependent on the ground floor tenant. So similar to a retail or office space, we would need to understand who's occupying the commercial units, what business are they, whether the rents are up to date. And so same as retail, office, and we still look for established business where cash flow and rental income can be stabilized and predictable. So moving on to other, these assets are not common and you don't see them every day. So with the exception of the flagged hotels, which we are still not participating at this time, we still have the appetite to finance the other types, for example, senior housing, mobile home parks, and self-storage, if there's stabilized and predictable cash flow. So we would be looking at the historical operating statements of the operator, as well as the current occupancy data and the current rent roll. So moving on to the next slide, please, Tracy. Thank you. So here's some of the questions that I get asked very frequently. So the first question, do we take personal income into consideration? The answer is no. So sometimes the buyer or the borrower wants to maximize the loan amount. So they wonder if their personal income or the income from other sources can be taken into account. But keep in mind that only the rental income generated from this specific property can be used to calculate the loan amount that we can offer. Next question is, down payment always 25% of the purchase price? The answer is again no. So as I mentioned earlier, the purchase price may be much higher than the lending value determined by the bank for various reasons. The rule is we lend up to 75% of the purchase price or the lending value, whichever is less. So the lending value, if the lending value based on the actual rent is much lower than the purchase price, then the down payment could be as much as 35, 40, even 45% of the cost. And secondly, we also have some population restrictions. So if the property that your client is looking to purchase is located in a city or town that has a smaller population, then the maximum loan to value would be reduced from 75% to 70 or even 65%, depending on the total population of that city. So the next question is, what interest rates can I expect, or can my clients expect? The interest rates are, from the bank's perspective, are the return for the bank, and the returns are based on risks. So no two properties are the same. Every property has, different cash flow, different building condition, different locations, and the investors or the guarantors would have different portfolio and different experience managing commercial real estate. So it really depends on the specific property and the transaction. So we would first need to understand the property, the specifics of the property, the tenants. So I suggest that you send us the rent roll and the operating statements for the property as soon as you have it. But what you should know is that RBC has been very strong in this market. We can price well to win the deal if it's a very high quality transaction. And we also have multiple funding channels. So we're very, I would say we're very competitive in this regard. The last question I have here is, what if my borrower is unemployed? Can we still lend to borrowers or investors that that are currently unemployed? So the answer is yes, but it also depends. They can be unemployed, but we would like to see borrowers that have experience in managing commercial real estate. And also, we would like to see borrowers that have existing commercial real estate portfolio. And the investor should also have a good personal net worth to be able to, if in case anything happens to the property, for example, the COVID hit in 2020. So would the borrower be able to fund any unexpected cash flow shortfall as a result of, COVID, for example? So these are the questions that I get asked very often. So with that, I'll maybe pass it over to Tracy. If you have any questions, please feel free to let me know at the end of this presentation.
Thank you, Iman.
Tracy, with that, yeah.
Thank you. I would suggest everyone record Iman's, contact information. We will have a question session later on after our presentation. But if not, you can feel free to reach out to Iman for your specific questions. So I'll be continue our presentations and little introduce myself. And my name is Tracy Liu. I have been with RBC Royal Bank for more than 10 years. I started working at a branch such as like personal banker, help the client with their personal banking needs. Currently, I am a business account manager, and I have been in this role for more than 4 years now. I work with business client, provide services on how to start, manage, and grow a business. So the clients will be sure they'll get the support they need from someone who knows the challenges and opportunities of their business, no matter what stage the clients are. When the business growing and reaching a certain level, their business would be more complex, either need more exposure to credit facilities or need access or more sophisticated platform, or the business owner have their own personal banking needs. Then I hand over the client to my different partners, just like commercial partner, Imon, and the residential market specialist, Ethan, who is coming today too. So then we'll help the client to manage their day-to-day, operating needs. I am a relationship manager, whether opening a business account, process a loan applications, Through my expertise, I have been able to help many clients reach their full potential. It all starts with a simple question. So please feel free to reach out to me. I'm here to work with you and your client. I strongly believe that building a business goes beyond far than making money. It is all about dreams, aspirations, and living life the way that your client want. So you can record my contact information for future reference. And today, our topic, we will focus on one topic, Canada Small Business Financing Loan. We call the CSBFL. Our presentation will cover the following area. We will have overview of this program and who would be the borrower, and about this loan size and class, about the loan percentage and amortization, the unique funding process, the cost and fees associated, and the application itself. Now, speak with this CSBFL, which is called this program CSBFL, is designed for brand new. The client could just incorporate yesterday, or a startup, which normally call those startup, let's say just established 1 year or so, or existing business. When we say that, just refer the client normally already have 2 or 3 years financial statement ready. For purchase or making some improvement. When we say the improvement, we normally refer to renovation. Or making leasehold improvement or improve lease property. What does that mean is the place is not yours and you lease that premises and you just making some leasehold renovation for your business purpose. Or you're buying a new equipment or upgrade some equipment. Now, the guideline is say this program is not for, it's for aimed for that gross revenue 10 million or less. That's why we call it a small business. Now, the borrower, which is the, who is going to borrow the money, could be the sole ownership under your personal name, or a partnership, or majority we see is a corporation, which is incorporated. What this program not eligible borrower is, currently we are not doing any owner who is on work permit or study permit, which the social insurance number start with 9. And farm, we do have other program, Canadian Agriculture Loan Program. So any farm income related, we are not applying for this program. Religion, charitable, they are non-for-profit, it's not eligible for this program. Or it's a trust or holding company, which means you can just borrow this holding company, use this holding company to borrow money for the business running business purpose. It has to be solely under the operating company. Now, the loan class, what we can borrow this money for is to purchase a real estate, let's say a property, commercial unit, or for making a renovation leasehold improvement, or buying equipment, or we will focus that registration fee because the government guaranteed, so that on the loan amount, on top of the loan amount, there will be a registration fee 2%. Now, if the client not able to pay the cash, we can add this 2% as the total loan amount as well. Maximum size, if you purchase a property, then the loan amount can go maximum 1 million. But in that 1 million, or if you only use the loan to do renovation and equipment, then the loan size will be maximum 350,000. Now, when we say this program, we can also use to purchase a business when the business does include the remaining leasehold and equipment value, which means on the purchase agreement, when you client purchase a business, that we expecting that you have a breakdown that status telling us that what is the amount residual for the equipment, a leasehold, and these are different things. And then we will have an appraiser to value this, especially equipment and leasehold, because we only finance on the equipment and leasehold portion. Now, for the loan to value, real estate, we can finance up to 90%, equipment 90%, leasehold up to 100%. Now, here's the maximum amount. In the majority, it depends the situation. When last year, COVID-19, we may, finance a little lower than that amount. Also depends the application itself. But maximum amount is this. Now, fee 2% that we can also add on the loan amount for the rest of the term. Amortization. So the long term, generally speaking, a majority of people do 7 to 10 years. But if we break down to them, real estate, property, we can do up to 25 years. Equipment and leasehold, we do maximum 10 years. Now, very important. How can we make sure the leasehold improvement, the renovation, that loan we can do up to 10 years? It really depends a couple of things. So one major important thing is how many, months the leftover when you take over the lease. So the lease agreement is the lease term period of the lease is equal the amortization term. For example, if the remaining lease term is only 3 years, then your loan won't be, exceed 3 years. So it's always capped by the lease term. So when we take over existing business, you have to read the original lease agreement, see how many remaining lease term that include the renewal term we have. So that will cap the long term. Now, lease agreement, we don't want to spend too much time on lease agreement because we encourage the client to hire a lawyer to read through your lease. But what we're looking from our view is we major looking at the lease term. We looking at how much you're putting a rental deposit because that occupied your working capital, your cash as well. And we're looking at if there's a landlord inducement, that amount will be subtracted from the leasehold improvement. And if there's a demolished term, which means the plaza is going to be demolished soon, something like that. Zoning as well, and sometimes we saw that commercial premises, they said this zoning only for your unit is only for 30% for retail and 70% for wholesale, but the client want to open the restaurant, and that's not the case. So we have to look very carefully about these things. So this program has a very unique funding system. It's not like when you apply for a mortgage, you get 300,000 approved, you get 300,000 cash. So instead, it has a 180-day rule, which means you may pay these things. Let's say equipment. You pay that. You bought a TV 3 months ago when it's on sale, right? Now we got approved. How can you get a reimbursement? The answer is yes or no. It depends how long when we look back. So the 180 days rule, which means you have 180 days prior to the date on which the loan is approved. Then you will be able to get it reimbursed. Now, what happened? We got the loan approved today. So when we can use the funds, you literally have 1 year from the day now and to have all the funds advanced. So these are the rule for funding timing. Now, how we can get money, right? So there's 3 ways to get money. First is majority is payment made directly to the supplier, which means once you finish the renovation, that present us with the invoice, we will pay the renovation plus your portion, of course, and to the renovation company directly. That's one method. Or when you purchase a property, let's say commercial unit or any purchase business through a lawyer, we will use that, payment pay to your lawyer, just like conventional loan or mortgage, the same thing. Or we just mentioned 180-day rules. We reimburse that the one you paid, through a reimbursement, but money will credit back to your account instead because you already paid for the vendor. Now, what is the cost associated with this program? So let's talk about the rate. The interest rate, majority people is taking the variable rate. This variable rate is open. You can close anytime without any penalty. The rate is standard primer plus 3. Speak with the primer today is 2.45. So today's rate is 5.45. Now tomorrow could be the primer increase, your rate increase. If the primer decreased, and then your rate will be decreased. We mentioned that 2% of government registration fee. It's a one-time, and on the loan approved amount, 2% goes to the registration fee. Now, there are some charges after the loan advanced. We have to do a title search, secure the registration, and we pay first, then we charge back to the client. Normally, we would say a couple $100, but no more than the $500 normally. But gang charge, we charge $175 document preparation fee and $100 application fee. These are the fees that we will notice, but there are the fees where we case by case. Each client's situation is different. Is the client may hire a lawyer, that's lawyer fee they have to pay. They may hire accountant, that's the fee they pay. Now for new business, they may need a business plan. They have to pay appraisal. These are the fees that case by case, but could be happening when the client, do a business. Now, what is the application required? Minimum 10% of down payment. We just mentioned that loan to value is 90%. So the client would have to pay 10% from their pocket. We're looking for working capital, which means if the client said, I have 10% of down payment and I'm intend to borrow 90%, are we able to finance on this situation? The answer is no. Because we have to look at the fallback. We have to look at it, what working capital you're holding in hand in order for the business up and running. We look at a minimum at least 3 months of working capital. But when the COVID-19 came, and then now we realized that maybe 3 months is not enough, and then we're looking at 6 months. We've seen 12 months, even 2 years working capital. The more is better. So business debt equity ratio, roughly speaking, is every $3 you want to borrow from bank, the owner has put $1. So that kind of like assurance for the lender as well. Now this program, we need a 25% personal guarantee to guarantee the loan amount. What does that mean is it's government guaranteed, which means in case something happens, the government will stand out to guarantee you because you pay 2% of registration fee already, right? However, the owner is still liable 25% of personal guarantee of the loan amount. For example, if you borrow $350,000, now your personal guarantee has to 25%, which translate to amount is $87,500. That's the amount when you apply for the loan, you have to show us your ability that you have that money. Now, we discuss about how we assess the loans. Basically, is first is if it's existing business, we use the financial statement that's signed by licensed accountant. If it's new startup, we can use a business plan, which you can do yourself or hire someone to do it. These are something that we're looking at. Very important, the owner has to have a good credit history because we solely based on your business plan. We based on these facts, government guaranteed, but still owners credit bureau history is also important as another sign telling bank how well you were likelihood to pay the future loan. So we speak with the financial statement and business plan. This unique for this one is if it's existing business, we normally asking for financial statement, which is signed by accountant. But because of a startup or brand new business, you don't have, then we accept business plan. So again, for financial statement, we accept a notice to reader. It's not T2, similar to T2, but we're really looking at has to be signed by a licensed accountant because we believe that accountant majority time wouldn't risk their license, right? Now, startups, which we do a lot in this program, and it's very strong for this program as well, is we using a business plan, which the business plan include the various things, business structures, how you run the business, detailed owner's experience, and as well as the financial projections, which is similar to the financial statement, but instead of previous year, we look at the future years. That's why we call the projections. So application, what we require is because this is still credit related, so we require specifically these personal document as well as the business document. But case by case, if you come into an application specific client, then we can send you a detailed list regarding the case. And another thing the owner need to clarify and prepare ahead of is what is the total project cost. We discuss about the down payment, we discuss a loan amount, but we want the client to think about how much exactly want to inject in this new business, not only the lower down payment, but also fallback, working capital, and as well as some personal, savings that also can take into consideration as a fallback. We also want to know that where the source of funds. You can't just file income tax return for no more than 10,000 a year. Suddenly you have $500,000 in your account. That will be questioned for sure. But again, case by case, and this is our very strong program that RBC does. If you have any question, you call recording to me, and we can ask your question later on. And then we can go from. So I've been help a small business client. I've been help even agent with the real home life. We does a lot of those programs. But whenever you have question, even you sign the purchase agreement, give me a call, send me email, then we can figure out what the best solution for your client. So thank you for that. My portion finished, and we will have a Q&A session later on. I'm going to hand over to our star, Ethan Pan, one of our top mortgage specialists. Ethan, it's over to you.
Thank you, Tracy. Can everybody hear me all right?
Yeah.
Very good. Okay, so a little bit about myself. My name is Ethan. My background is in civil engineering, graduated from University of Toronto 2010. Subsequently, I worked for the Ministry of Transportation for about 4 years, got my license as a professional engineer, and then I started working for RBC. It has been almost 7 years now with RBC, and I'm very fortunate to have been the top 1% in Canada in terms of production and volume. So this means we have a lot of experience in different types of deals. So today we're going to talk about primarily 5 types of policies or different programs that we have, very competitive in the market, and I believe they are those policies are the primary targets for your client as well as a realtor focusing on the residential side. The 5 programs are Newcomers, Foreign Income, Wealthy Accumulator, which previously were called High Net Worth, also self-employed individuals, and lastly, medical professionals. So we'll move to the Newcomer program first. So this program, I would say right now, is the most competitive program that exists in the market compared to all big 5 banks, because our Newcomer program does not require a traditional type of verification of income. This means that our program is going to be based on primarily the projected income of a client's ability to service the mortgage. In other words, even if the client does not have any income in Canada, but because the client has good education or the client has demonstrated previous income level, for example, they've worked in the US or in China or in Iran, and they had been, prior to immigrating to Canada, they had been earning $100,000 or $150,000, we could use that income instead of client's current Canadian income to qualify the client. So the target audience for this program is newcomers, meaning that they've been in Canada for less than 5 years, or if they are Canadian citizens, but they've left Canada for 5-10 years, now they are returning to Canada. We can also qualify those clients as well. And most importantly, this program is good for newcomers who were on study permit or work permit. They have not yet got the actual lending paper, but they have a letter from the government of Canada saying that they have been approved agreement in principle. So we can qualify those clients under this program as well. Let's go to the next slide, which talks about the requirements. So pardon my slides, they are written in Chinese, but if you guys have any questions, feel free to give me, to let me know afterwards. So for this program to work, we require a minimum of 35% down payment. Besides that, the client needs to demonstrate that they have sufficient funds after down payment to service a mortgage. Effectively, the clients need to prepare about 40 to 42% of down payment. But the down payment is only 35%. We'll lend the remaining 65%. The maximum lending amount is $1 million. Note that this is the mortgage amount. Effectively, it means that the client can purchase a property for about 1.5. They'll put down a third, and then we'll lend them the remaining 2/3. And this program is only applicable to primary or second home, meaning you cannot use this program to buy an investment property, but you can use this program to buy a property for yourself or even for your kids or your parents as a second home. So the first example that we'll show is we have a newcomer couple, husband and wife. They landed in Canada, let's say in 2016. The current income in Canada is only $45,000, right? So right now they are near the end of the 5-year grace period in Canada. They are looking to buy a property for 1.5. In this case, if even the client are only earning $45,000 in Canada, which means that if we go with the traditional income verification, then we can only lend about $250,000, about 5 times of their Canadian income. But because they are newcomers, and because they can do 35% down payment, so it is very likely that given the background of the clients, we can lend them the remaining $1 million. The second example is where a person immigrated to Canada in 2013, and they have good income in Canada, about $60,000. They're looking to buy a property for $800,000. They have some money in Canada, some money in the overseas. They have demonstrated that they are currently in Canada enrolling in a program where it enhances the client's employability, meaning that even though the client currently is only making $6,000, but because the client is taking a master's degree, or if the client is taking additional certification, we can use a projected income, maybe about $100,000 to qualify the clients. So in this case, we should know that the client landed in Canada in 2013. So they've already passed the 5-year mark. But if we can demonstrate that which is typical for many clients, is that they do the initial lending, short-term lending. They go back to their home country. They settle their real estate, their estate overseas, and then they relocate to Canada to permanently settle. Let's say in 2018, 2019. So even though the PR card was issued in 2013, but we can demonstrate that the client only came to Canada at a later time, which is still within the 5-year period, then we can still qualify the clients under the Newcomer program. The next scenario is where the client was on a work permit. They transition to PR card. The down payment is gifted, and the client is in the process of obtaining CFA designation. Again, this is our very typical clientele, where the down payment is gifted and the client's current income is very minimal. But because we can demonstrate the client has the potential of earning sufficient income to service the mortgage, so even though the down payment is gifted and even though the current income is very limited, we can still provide financing to this type of clients. The last scenario for Newcomer program is where the client was a Canadian citizen. They landed in 2003, went back to China, came back in 2018. In this case, even though the client is already a Canadian citizen, we can still qualify this client under the Newcomer program. Okay, so those are the few key aspects of our Newcomer to Canada program. The next policy is one where we encounter very frequently in the Toronto area, where we have young clients. They are currently on work permit or study permit, and they are looking to settle in Canada, but they either don't have a PR card or their current income is insufficient. In this case, our advantage at RBC is that we can use the client's guarantors foreign income to qualify the clients, provided that the client's guarantors has sufficient income overseas. And the other key aspect of this program is that we don't have to have the co-signer on title. This is a key advantage for clients buying in the Toronto area, where if the guarantor is on title, then they have to put up 15% an RST upfront, and they will not get the taxes back unless the guarantor also becomes a PR or work permit or whatever. So that's almost near impossible. So this is our key advantage for our foreign income program, where the co-signer does not need to be on title. The key aspect of this program and the key requirements are, first of all, 35% down payments. They have to provide confirmation of foreign income. So we typically lend between 4 to 5 times of the co-signer's foreign income. So let's say the co-signer is making $200,000 income overseas, Canadian equivalent, then we can lend about $800,000 to $1 million Canadian mortgage. This is also based on the assumption that the client has no other debt. This program is, again, so only for primary residence or for a second home. So the first scenario is very typical, is where we have a Chinese national working in Beijing in China, but they have their kids looking to move to Canada, or they're already in Canada on a study permit, enrolling in elementary school or high school. In this case, they are looking to buy a property for about $1 million. Provided that the client has sufficient income overseas, then we can lend about for a maximum of 65%, so up to $650,000. The second scenario is where the clients are Canadian citizens, but they are working in Shanghai. They are non-tax residents in Canada. and they are paying taxes in China. They already have a mortgage in Canada. They are looking to purchase a second property. In this case, they are buying property for $1.5 million. If they have sufficient income, even though they are Canadian citizens, we can still qualify them under our foreign income program, and we can lend them a maximum of $1 million. So those are the two typical scenarios that we encounter for this program, foreign income. The next one is the Wealth Accumulator program. The key benefit of this program is that we don't need any traditional income verification. This means that the client, let's say the client makes a minimum, the client's retired, they are only receiving OAS, so old age security, or even if they are on EI, or even they only have rental income. But because the client is able to demonstrate that they have sufficient liquid assets to service the mortgage. So I would say again, liquid assets. So we look at it, mutual funds, even RSP, TFSA, but we do not consider fixed assets. For example, a free and clear real estate. So we don't take that into consideration. Rather, we look at investable liquid assets, so cash savings, GICs, etc. So this program can be used not just for primary residence, but also for investment properties. The key requirements, again, is 35% down payment, and we need 90-day history for this type of program. And the client needs to have good credit score. So if we look at the first scenario where the clients are newcomers, there are PRs, came to Canada in 2008, their current income in Canada is only $80,000. They already have a mortgage. The balance is about $500,000. They're looking to buy a property for 1.5. So in this case, the math goes like this. So they already have $500,000 mortgage. They want to buy a property for 1.5. So if they are able to show that they have liquid assets for $2 million, which is 1.5 plus $500,000, then even if the client's income is $80,000, or if they have no income in Canada, we can lend them a maximum of 65% of 1.5. In this case, it's going to be $1 million. The second scenario is also very typical. Is where we have a stay-at-home mom. The current income declared in Canada is only $30,000. She has no debt. She wants to buy a property, whether it is a second home, a primary, or an investment property, it doesn't matter. She's able to show that she sold a property overseas. She moved the money to Canada, and she has about $400,000 liquid assets in Canada. So in this case, even if she has minimal income in Canada, we can lend her 65% of $400,000 property. Okay, so that summarizes the high net worth or wealth accumulator program. The next program we have is self-employed, which is for those of you who are here, realtors who receive T4A commission income, or even for those who have a corporation or holding company, but they work for themselves. The key thing for this program is that, again, even we understand at RBC that for self-employed individuals, the gross income can be significantly higher than what's declared on the notice of assessment. So, for example, I have clients who are top performing realtors. They are making on their T4A, they're making $500,000 income, but because of the deductions, the expenses, on the notice of assessment, we only see about, let's say, a $120,000 income. So in this case, if the client is able to provide confirmation that their gross income is significantly higher than their declared income, then we can potentially use 3 times of what's declared on the notice of assessment income to qualify them for the mortgage. The key requirements, again, 35% down payment, and the down payment needs to have 90-day history, so the down payment cannot be gifted in this case, and it can only be used for primary residence or for a second home. So let's go to scenario number 1, is where we have a self-employed individual, a realtor. The T4A income is $200,000, but on the notice of assessment, it only shows $50,000. The client has about $200,000 mortgage, no other debt. If the client is able to do 35% down payment, then the potential mortgage we can lend potentially is 4 times the 150. So the 150 is 3 times what's declared on the NOA. So the client declares 50,000. We can gross it up to potentially 150. We can lend about 4 times of that. So that's $600,000 mortgage minus $200,000 current debt. So we can lend an additional about $400,000 mortgage. So potentially we can increase that a little bit more, depending on the client's type of a business, the type of the level of savings the client has. So this is a rough calculation of what we can do. The next scenario is where the clients are self-employed. They have a corporation. They're incorporated. They're not sole proprietors as like before. The declared income for the family is only $50,000, but the client is able to provide bank statements, the business bank statement, to show that the average monthly deposit is $20,000. So when we annualize that again, so we can show that the revenue is about $240. So even if the client only declares $50,000, in which case we can only lend about $200,000, because of the fact that the client is self-employed, they have very healthy cash flow. If they can do 35% down payment, then we can potentially lend them $600,000 mortgage. Okay, so those are the 2 scenarios. One is for sole proprietors, such as insurance agents or realtors. And the second scenario is where the clients are incorporated and they have either business financials or bank statements to confirm the actual level of income from the business. Okay, so those captures the few key programs that we have at RBC that I believe are going to be very competitive in the market. And here is my contact information. So my branch before COVID, of course, is based in Fairview Mall, and my cell phone number and my email also attached here. And below that is my assistant's contact information. So I have 2 assistants. As one of them has been with me for about 4 or 5 years. So she's very capable. So if you are unable to reach me, feel free to reach out to my assistant as well. Thank you, guys. I'll hand over to Tracy.
Thank you so much, Ethan. So I think we're going to the fun part. And again, this is our contact information. Those who came late, you can just record our message, and then you can feel free. We are very honored to be here, and feel free to reach out to us for any questions. So now we go to a Q&A session. So I just want to know. I've seen that the chat box there's some questions here, and now before we do that, anyone had a question that you want to raise your hand or something? David, how we can do the question Q&A? We just look at the chat box.
Yeah, they can stand in the chat box here, and they can unmute himself, so that's fine. Anyway.
Oh, okay.
Yeah.
Right. Anyone have questions?
Yeah, few already in the chat. So can you look at that? I send you one. Then someone asked for commission income client. So those kind of questions you can answer first.
Right, I'm on. Will the higher cap rate get higher loan amount for a commercial property? I'm on. This is for you.
That's my question. Okay.
Oh, yeah. Okay.
Thank you, David. So the question is, will the higher cap rate get higher loan amount for a commercial property? The answer, it would be the opposite. So the lower the cap rate, the higher the purchase price. Right, so potentially the client can get a higher loan amount if the cap rate is lower. Remember, the rule is 75% of the purchase price or the lending value determined by the bank, whichever is less. So I would say yes. So it would be the opposite. However, loan to value is not the only financial criterion that we look at. We also have some other financial metrics. For example, the DSC, the debt service coverage ratio, which is the ability to service the mortgage. So generally speaking, for a property in the GTA, the minimum debt service coverage ratio is 1.2 for a multi-residential building, or 1.25 for a retail building, or an office, or an industrial building. So what this means is that for each $1 mortgage payment, the property has to generate at least $1.20 in net operating income for a multi-residential property, or it has to generate at least $1.25 in a net operating income for the other types, so retail, office, or industrial properties. So quite often, so I said potentially the client can get a higher loan amount for a lower cap rate, because quite often we meet the minimum debt service coverage ratio requirement first, giving us very limited or even no more room to increase the loan amount to get closer to 75% of the lending value. So the short answer is it will be the opposite. So I hope that answers your questions, David.
Thank you, Iman. Actually, my question is something a little bit different from yours. That means higher cap rate. That means it's easy for the bank to approve the mortgage. Is that right? Because sometimes lower cap rate, of course, it's not income property, right?
Not necessarily. We would also look at, we would also refer to the appraisal statements, appraisal report, which are completed by bank-approved appraisers. Mm-hmm. So they would have to be aligned with, the market cap rate, right? Especially compared to the similar properties in the immediate area. So it would have to be aligned with the cap rate in the area for similar properties.
Understood. So the reason that I got one property at the downtown Chinatown, so far because of the pandemic, so second floor, third floor is vacant. Used to be fully rented.
Occupied?
Yeah, because of the pandemic, now it's half rent only. So in that case, it's easy to get a loan, or will be pretty difficult?
If the client only requests for a very small amount, maybe we could have a look at it. But if they ask for a maximum loan amount, let's say 75% of the market value, then I'd suggest that we defer or hold on to it, right? Hold on to it until they can release and find new tenants to occupy and to collect rental income. Because at the end of the day, we base on the actual rental income, right, which come from the leases and the tenants. So if there's no tenants, or if the units are not occupied, then there's no stabilized cash flow or predictable cash flow for us to calculate or service the mortgage.
Understood. Thank you. Yes, good answer.
Thank you.
Okay. Thank you. Here's one question for you, Eamon. How long is the commercial property mortgage approval process? How long, roughly speaking? There's a question for you.
That's a good question. Roughly speaking, we would be looking at anywhere between 4 to 6 weeks, assuming that things go smoothly.
Yeah, that means that everyone here, if you put offer in for commercial property, so the condition for financing should be at least 4 to 6 weeks at least. Okay?
Yes.
Normally, sometimes we ask for 90 days or 60 days, 90 days. We've been much better, right?
Yeah, to be more conservative. Right. Yeah.
Right. And we also suggest that when you help client put in the offer, once you have a rental roll, you can reach out to us, reach out to Iman, have a look about, because it's really commercial is a case by case. I always got, realtors send me the rental roll. Can you look at this one? How much, the maximum loan approximate. We are not giving out the firm answer, but if we say this is only, let's say their client bought a 1.5 million property, but the mortgage only can go 400,000, right? That situation happens. So back to your client is that, do they have the down payment? Are they still willing to buy that? Because the loan amount wouldn't be dramatically jump from 400 to 1 million. That's not going to happen. So we can help you, help the realtors to close the deal sometimes by this way also. But again, there's no bad question. You can always reach out to Iman, and you can reach out to all of us, any of us. And then we work as a team, Ethan, me, Iman. Sometimes we feel that, this maybe some other people can try out, and then we can hand over to them. So there's no bad questions. Now, one question I believe is for Ethan, that what are the terms and conditions for commission income client? So Ethan, I believe this is questions for you.
Yeah, I believe so too. So the basic requirement is that the client needs to have. So I'm assuming you are asking about how to qualify under the stated income program, where the personal notice of assessment income is relatively low, wouldn't qualify for a significant amount of mortgage, but we have alternative methods of verifying that the client's actual income, whether it is a retained earnings, whether it is T4A income, the gross income, we can demonstrate that income is significantly higher than what's shown on the NOA. So if you're talking about that program, then the basic requirements are first 35% down payment. The down payment cannot be gifted, meaning that you have to be able to show that you've had the money for a minimum of 90 days in your bank account, or it is generated from your own business income. Let's say you sold a property, so from invoices or from commission slips. So that's the first requirement. The second requirement is that you have been, at the time of application, been self-employed for a minimum 2 years. You can demonstrate that by either master business license or T1 general for those who are self-employed as a sole proprietor, or from articles of incorporation to show that you have been at least as a self-employed individual in this field working for a minimum past 2 years. That's the second requirement. And the last key requirement is that you can only use this program to purchase either a primary residence or a second home. So second home definition is property will be occupied not by tenants, but by your parents, your siblings, your sons and daughters, so by immediate family members. So those are the three key requirements. And lastly, I should mention that the aggregate lending amount for this program at RBC is capped at $1.25 million. In other words, if the client currently has no mortgage, or mortgage but not with RBC, let's say the mortgage currently is with RBC and the client now is purchasing a primary residence, in this case, we can lend $1.25 million subject to tiering requirements. Again, so 65% loan to value. This is scenario number one. Scenario number two is if the client already has $1 million mortgage with us, with RBC. In this case, if the client wants to buy another property, the maximum we can lend is only $250,000 because we have an aggregate lending amount at 1.25. Does that answer your question?
I would say if you still have any questions, why don't you just call Ethan and then you can have one-on-one session. I got one question for myself is when realtors say, do you guys still do the CSBFL? Actually, this is a very common question last year. Say, hi, we heard that you're not the bank's not doing the government loan anymore. The answer is we always open for business. And actually, and I had loan even for restaurant financing approved during COVID-19, and that possible. And I would always say we open for business, but we have to be very not creative, but we have to be very mindful. We have to look at the whole picture. For example, your client is buying a property from IMO, right? So because of the become landlord, but you can help your tenant to get a small business loan. Once tenant has the ability, then your rental room will be beautifully, right? Also, if you're looking for commercial or small business loan, you can also look at the personal side of your client. Can we, transfer your mortgage or increase your line, sort of things that to give you the readily access the cash in ready for the business as well as a fallback. These are some commonly used. We will work together as a team to look at your client's whole picture. So these are things that we always happening in the real life. And I always got a call from the realtors say, hi, the sellers realtors say, why you need that, right? So but buying, asking and talking, working together, that we can reach a different level. So thank you so much, Ethan and David. Do you have any other questions for us?
See everyone. If any question you can ask now before we finish the section, right? Today is a really great topic. Tracy, thank you, Sean, thank you, Tracy, and Iman and Ethan. Really, because the first time we hold such section with everything, commercial, residential together, right? And also in commercial, people normally don't understand that commercial. So far today, we have two sections. One is for commercial property. Second one for business for sale. So those we have two teams already here. Iman for commercial property, Tracy for sale for business. So those are kind of in commercial real estate for sale, right? Ethan for doing residential as well here. So that's great. So everything we have everything already for us here. Thank you so much. Anyone really needs something, contact Tracy, Iman, Ethan, and whenever you need it to, right? So if you lose any contact information, you can come to me. I can get back to you.
Yeah, thank you so much again. Today we just touched a little bit about commercial, residential. That we just raising the question or topic about very hot, commonly question. But it's especially commercial. It's extensive, product services. So we're not able to cover everything. We just cover a major two big topic. But if you do have any questions, please do not hesitate to reach out to us. Again, thank you so much, and thank you, David. And we're looking forward in the future. We're going to do an in-person, just like previous one, and then we can get know to each other more closely. Thank you so much, and have a wonderful day.
Thank you, Tracy.
Take care, everyone.
Thank you, Ethan. Thank you, Sean.
Thank you, David and team. Thank you.
Okay, we'll see you next time. Yeah.
Okay. Take care. Yeah. Thank you.
Bye.
Okay.
Bye-bye.